Thank you for everyone listening in today. Welcome to our review of Bristol-Myers Squibb's first quarter earnings. I'm Mike McGinty, a senior wealth consultant with Mariner Wealth Advisors, and with me is Jeff Krumpelman, chief investment strategist and head of equities for Mariner Wealth Advisors. To kick us off, Jeff is going to dive into some of the fundamentals of Bristol-Myers stock. Jeff, take it away.
Well, thanks a lot, Mike. And, I think before I just dive straight away into the fundamentals of Bristol-Myers, it might be worthwhile to provide just a couple bullet points on the healthcare sector in general right now, because you kind of need to know the neighborhood in which you reside. And healthcare stocks, wonderful sector last year in 2018, the top performing sector in the S&P 500, up somewhere around 5% last year when the market was down over 4%. This year it's up about the same amount that it was up for the full calendar year of 18 in just the first couple months, but it's lagged the S&P 500 in a big way, up somewhere around 5%, whereas the S&P is up over 13%. And, the issues that are out there and the reason for that underperformance, is just a lot of political rhetoric, concerns about will there actually be, drug pricing controls that are legislated? What about doing away with Obamacare? How will that impact, these stocks? And that is just kind of putting a lid. There's been some PE contraction. And so all the stocks, pharmaceuticals, biotech, managed care, have suffered just a little bit from that. But really the key thing here is, okay, let's talk about Bristol-Myers because it's in a very interesting chapter. So on that front, just, who is Bristol-Myers quickly? They're a large company, $24 billion in total sales expected for 2019. And those sales are concentrated in two areas where they compete very well, one in oncology, the other in cardiovascular. And within oncology, they also have concentration in product sales in Opdivo, which is really their lead product, 30% of total sales, a big part of oncology. And Opdivo is currently approved and used for second-line treatment in non-small cell lung cancer, so well-positioned there. Also approved in renal cancer, and they have shots on goals in gastric and other type of cancers. But the issue with Opdivo is they've got significant competition with Merck's Keytruda that really is the company in first-line non-small cell lung cancer right now, just really well-positioned, and actually making it more difficult for Opdivo even in second-line treatment right now. Then the other area, Eliquis, is within cardiovascular. And both of these drugs, it's also, I should mention, Eliquis, 30% of total sales. So between the two of them, it's 60% of product sales. Both of those drugs are actually growing at relatively attractive high single-digit to close to double-digit growth rates through 2022, but they're declining. They also face patent expiry in 2025 and beyond, and that's a real issue. And more recently, we've seen a deceleration in sequential growth in those drugs and some pricing pressure as well. So the bottom line from all that, Mike, is that because of the concentration in sales, the concerns about patent risk in these two particular drugs, rising competition from Merck and others, and not a lot in the pipeline, Bristol recognizes that it had a growth challenge and needed to do something, needed to buy some growth. And as a result of that, they've reached out and recently an acquisition of Celgene, a biopharma drug, and I'm sure we'll get into discussion about this. But the purpose of that was to help fill this pipeline gap, drive growth, and really position them well for the future. And that's a big part of what's going on here.
Thanks for the background info, Jeff. As many of you know, Bristol-Myers Squibb is to acquire Celgene, as Jeff just alluded to, and to create a premier biopharma company. Can you give our listeners some specifics about the deal, maybe some pros and cons of the transaction?
Yeah, sure can. And you know, there's a lot of debate going on about the pros and cons. And there's a lot of people that think there are a number of pros. There's a lot of people that think there are a number of cons. So first of all, it's a sizable acquisition, $74 billion acquisition. And to put that in context, Bristol-Myers has a market cap of about $76 billion. So this almost doubles the size of the company if you look at it on what they're paying for it, and then also from a sales standpoint, Bristol's got, you know, $24 billion in expected sales in 19. Celgene has, you know, $20 billion-ish itself. So it doubles the size of the company. It's very meaningful. In terms of the structure of the transaction, if you're looking at, you know, what they're paying for Celgene was trading in the low to mid 60s when the deal was announced. And if you look at the total purchase price, the Celgene shareholder is getting a little over $100 a share if everything plays out well. They get $50 in cash. They get one share of Bristol-Myers, and Bristol right now is trading about $46 a share. And they also get a contingent value right, known as a CVR, that gives the Celgene shareholder about $9 a share if Celgene is successful post-acquisition in introducing some new products and hitting some hurdle rates, you know, on that. So a little over $100 a share. So a decent premium for the stock. But Celgene had really traded down in advance of this announcement. Celgene hit a high more than $140 a share a while ago. So actually, this looks to be a relatively attractive acquisition in terms of what's being paid from our viewpoint. Now, the pros of the transaction, let's talk about those. The first would just be, this is a cash flow monster. $45 billion in free cash flow will be generated in the first 3 years of the acquisition. It will be immediately, meaningfully accretive, 40% accretive in the first full year. And it's interesting that this will kind of jumpstart near-term earnings per share growth for the combined company. Bristol looking to, you know, increase earnings on a standalone basis in the mid-single digits. This will make it a high, well, I should say a double-digit grower, because the products that they're acquiring, Revlimid, Celgene's Revlimid for multiple myeloma being the primary drug, along with some of its others on a combined basis, is growing in the mid to high teens. So when half of your company has that kind of a growth rate on a blended rate, you're really jump-starting, accelerating that near-term earnings growth. Other pros of the deal is that this cash flow can be used for dividend payment, for debt repayment that they'll need to do, for shareholder buybacks or share buybacks, and to invest in new companies, or new products, I should say. And then the pipeline that Celgene has, late phase and early phase, is a little more promising here. And that could add to some near-term growth if they execute, and some later phase growth out in that 2025 period. So those are kind of the pros. The cons are this: there's a heck of a lot of execution risk here. This is a tough industry, as everybody knows, and there are no promises in these various mid-phase and even late-phase trials as to whether or not you're going to get approval. And some recent announcements that Bristol has made to withdraw applications for Opdivo and Yervoy as an example of what can happen kind of in trials where you just have to move away. So there's execution risk, I would say, is just a big part of this. You've got patent expiry of both companies here that, you know, again, I'm talking about 2025, but even so, 90% of Bristol's products go off patent in 2025 and beyond, and 70% of Celgene's do. So you may get a little acceleration near term, but investors go, uh-oh, then what? And so that can put a lid on the multiple that investors are willing to pay. So despite the growth, you're looking at pro forma kind of valuation of 7 times on the combined pro forma earnings because of this execution risk that folks are worried about. And then the added thing I would say for Celgene in terms of a potential con would be that they've got some competitors that could launch at risk for Revlimid, which is north of 60% of their sales. There's litigation ongoing. There's patent challenges that could render those patents either at risk or invalid, far earlier than the current, kind of 2024 and beyond time frame. So those are the cons, Mike.
Got it. So with this deal on the horizon, can you speak on the valuation of Bristol-Myers stock?
Yeah, I would just categorize it as attractive, cheap, would be the way you'd put it. And many times there's this patent risk out there. That's what happens with these pharma and biopharma stocks. The PE multiple contracts to, low double-digit or single-digit levels. And right now, the pro forma valuation is 7.3 times 2020 pro forma EPS estimates for the combined company. And we couldn't help but think that the stock is, close to kind of a bottom valuation, if you will. And I wouldn't expect a lot more downside for that reason. I will mention that there are some shareholders out there, some large and meaningful and respected shareholders that actually are focusing on the cons of the transaction and really don't want to see it happen because of the execution risk and the debt that will be, put on the balance sheet as a result of this. And so there may be some selling. The deal is very likely to be approved. We would expect it to be on April the 12th. We think shareholders will approve it, and there could be some selling after that that could put a little downward pressure on the stock from these low valuations. But we would think that you're closer to that bottom if that puts it in perspective for you.
Yeah, that does. That's great.
Sure.
Can we look back real quick on the fourth quarter of 2018, and maybe you can give us a summary?
Yeah, there's probably only a couple bullets on that. If you looked at the quarter, it actually was an inline quarter with regard to sales. It was a 10% EPS beat, but I wouldn't necessarily call that an impressive beat because most of it was via cost control. And in this industry, folks would much rather see, beats because of upside surprise on sales rather than managing costs. There were 2 pieces, I would say, of disappointment to concern in the quarter. And the first, I kind of alluded to this earlier in our conversation. Bristol-Myers did announce the voluntary withdrawal of its application for Opdivo, Yervoy, and non-small cell lung cancer, the 227 study, part 1. And this was a study that would potentially make them a gamer, if you will, in first-line non-small cell lung cancer. And, this, I think, announcement pretty much relegates them to a niche player within non-small cell lung cancer, largely in that line, not the first line, the first thing that cancer patients would turn to, but the second after they cease reacting or responding to the first line. And so that relegates them to a lower addressable market than they would have wanted. Now, there are some follow-on studies, I'll just mention this, Opdivo with Yervoy and with other chemos that I think will actually show pretty well, but they'll be Me Too-like, and they just won't. What you needed was kind of blockbuster results to show that they could shine in comparison to Merck's Keytruda in first line, and you're just not going to get that. So that was a real disappointment. And then the other is a little more minor, but you saw deceleration in the pace of growth within Opdivo and second line, and you also saw pricing pressure in Eliquis, which is their blood thinner, and that was just, a cause for a little bit of concern. So I would say that it was, a bit of a disappointment on those factors, and that's what kind of, captured the attention of investors.
Got it. So with all this information, can you give us some final thoughts on Bristol-Myers stock?
We can, and I know how frustrating it is. A lot of people say, hey, you investment people, and they throw economists in that too. On the one hand, on the other hand, all this stuff, good for you. I'm glad you know all that stuff, but what are you really thinking here? And, I think the bottom line here would be neutral, if you will, and I even know that sounds like investment mumbo jumbo a little bit, but more of a hold. We wouldn't be aggressive buyers or aggressive sellers of the stock in here, and we do recognize the value, and we appreciate the value at 7 times pro forma 2020 earnings, but we also appreciate the risks and the fact that PE is unlikely to expand significantly, and so you need to deliver on current expectations to realize kind of that market perform value. And we think that that's kind of what you'll get. The stock is a $46 stock. Sure, you could have some near-term pressure if some of these shareholders lighten up, but there's a lot of support at the $45 level and in the low 40s at very cheap levels. And given their earnings growth, to see a market perform, a high single-digit to double-digit annualized kind of return from a price standpoint over the next couple of years would not be surprising to us. And you have a nice dividend in the interim. So for an income-oriented investor that sees some potential price upside, it would be interesting, but we would put it more in that market perform category.
Okay, great. Jeff, thank you for sharing your thoughts today, and thank you for everyone who listened in. If anyone has any questions or wants to reach out to me, feel free to email me at michael.mcginty@marinerwealthadvisors.com. Thank you for listening in, and hopefully I'll hear from all of you soon.